Let's get across the market open. Jason Yin joining us from Lincoln Indicators. Jason, welcome back. Good to have you on the show again. Some further developments overnight. The prospects that Iran and the US are close to some sort of deal to end the war. That, as well as that AI trade, certainly boosting what we saw on Wall Street.
Yeah, that's right, Andrew. Markets were up really strong last night. US up around 1.5–2%. And I think overall, markets and investors are concluding the probability of a true worst case escalation has truly fallen. And over the past couple of weeks, we were just looking at scenarios where supply disruption in the Strait of Hormuz was going to spike more aggressively. But overnight, we saw a softer rhetoric, especially from Trump, including the pause of Project Freedom and also comments around a great progress in terms of Iranian peace talks. So that's seen oil prices ease, bond yields have also stabilized, and gold has increased.
So full details yet to emerge, but as you mentioned there, in fact, more records. In fact, day after day, we're seeing records on Wall Street, both the Nasdaq and the S&P 500. So the market's obviously moved on from the war with Trump trying to find an off-ramp. Is this now really about that AI momentum?
Yeah, look, AI has driven a very strong earnings momentum and also earnings expectations with where GDP growth is going. In terms of the massive spend for hyperscalers, we are seeing a lot of investment. And I think once a lot of the dust settles down in the Middle East, that's probably going to be the segment that is going to drive the next leg up in the market. Look, overall, equities are expensive. But the reason they're expensive is because there's a lot of expectation that growth is going to come from this AI trade that could have pretty long legs to go.
Jason, a bit of a different scenario having panned out here in Australia with the local index, which has been under tremendous pressure. Some relief yesterday. Looks as though we're going to get another bounce again today. Nonetheless, clearly the prospect of further interest rate hikes is weighing on the market.
Yeah, that's right. It's been pretty disappointing. In terms of the RBA commentary that sort of came out, inflation is still very persistent in Australia, and we saw the RBA lift rates by another 25 basis points. And I think pressure is building overall. Markets were purely a little bit worried that consumers would be impacted from a lot of the mortgage stress, but that pressure is now extending across different parts of the economy, and we've seen persistent inflation in terms of food and also general household expenses as well. So we are expecting a couple of more interest rate hikes in September and also one in potentially Christmas to take us to around maybe 4.7 or so percent, which is actually quite high, but hopefully a lot of the restrictive monetary policy that we have seen will ease some of the price inflation that's coming across.
Well, Jason, of course, the Australian consumer under tremendous pressure, and as a result, the retail sector one of the hardest hit. In fact, we're getting more warnings. Yesterday we had JB Hi-Fi. Today we've got Super Retail.
Yeah, that's right. Reading the commentary from both of these companies, it seems like their consumers have totally closed off their wallets and they remain under a lot of pressure. We are seeing that they are spending more on necessities and also value-orientated categories, with large ticket discretionary items obviously becoming very, very selective. For example, in super cheap retail, management said that like-for-like sales have slowed to effectively 0.4%, and gross margins are modestly expected to decline in second half 26. And notably, the most impacted division was boat, camping, and fishing, and with all regions and categories experiencing a pretty adverse impact from weaker consuming spend. And it sort of makes sense with diesel at around $3 per litre. You can see a lot of consumers choosing to stay at home rather than going out and enjoying a lot of those leisure activities.
Now, Jason, of course, amidst the fuel crisis, there has been a real spike in demand for EVs. How do you see that playing out locally, particularly with government policies? A bit of speculation about what changes may be afoot next week with the budget as well.
Yeah, that's right. Look, I think this is probably the one of the only areas that has had a pretty favorable outcome, Andrew. We saw over at the start of this week, the Australian government did extend the EV or fringe benefits tax exemption beyond 27 and potentially making it permanent beyond FY29, which looks like a pretty good outcome for a lot of people that have adopted or choosing to adopt a lot of electric vehicles. In terms of the actual winners within this category, we think the most well-placed are Macmillan Shakespeare and also Smart Group, because a lot of their earnings come from novated leasing activity, and we see this favorable FBT as supporting a lot of that. I was speaking to someone that worked in the novated leasing field yesterday, and effectively they said that volumes are actually 3x what they were previously. Everything has been sold out. You're looking at a lead time of 2 to 3 months for new Tesla vehicles. BYD went through the roof. I think that the data on that was a wait time of around 4 to 5 months. They have seen a lot of stock come into the country, so it's come down to around probably 2 to 3 weeks. But BYD is probably going to be a big winner from this. And if you were to think about how to capitalize on that, maybe someone like an AP Eagers, who used to have exclusive distribution rights of BYD in this country, could also leverage a little bit of that momentum.
And Jason, what about further down the supply chain, just in terms of looking perhaps at battery technology and lithium? Obviously, lithium has been hot. Are you tempted by that?
Well, we have been tempted in the past. We got a little bit burnt, but then when the likes of PLS went down to $1 or so, we thought that the EV thematic is still alive, albeit they were a little bit subdued in terms of spodumene and also lithium carbonate pricing, and that's why a lot of those shares went down. So we continue to hold exposure and rode it all the way back up. I mean, at these levels, we are trimming a little bit as well because of the decent gains that the share prices have made over the past 6 months or so. So we like the longer term thematic, but in terms of lithium, look, it's one of the most abundant resources that we have on this planet. And we have a lot of mines that are coming online over the next couple of years. So in terms of rarity, it's not really that rare. But in terms of production and also mining volumes, once a lot of that comes online and increases, price will come down. And therefore, I don't think the current elevated share prices can be maintained at these levels. So we are selective, and we're also a little bit cautious with where they are right now. But on the whole, we still like the EV trade.
And Jason, just further on commodities, obviously with a focus on oil, how are you playing energy at the moment, bearing in mind, of course, what's transpiring in the Middle East?
Yeah, that's right. We've maintained a pretty, I guess, above benchmark exposure to Woodside and Santos. We continue to like both of those companies. Woodside has a really strong balance sheet after divesting a bit of Scarborough to the Japanese, so they have ample leverage and ample room in terms of sustaining a pretty attractive dividend yield. And when you consider if you're an investor that is eligible for franking credits, that yield at around 8% looks kind of juicy, with the prospect of obviously oil price volatility that could ebb and flow. Right now, the oil price that I'm looking at today is probably around $96 a barrel. We think Trump is probably not going to reach a conclusion with Iran over the next day or two. I think it will probably require the inputs of the Chinese to come in, and that could potentially take place in around mid-May when Trump goes to Beijing and has his summit with Xi. So in terms of oil price volatility, despite the fact that oil prices have come down yesterday, we still feel that there is going to be a little bit of an upside with where it is right now. So we are maintaining our exposure in Woodside and Santos, but we are cognizant that at any time, these taco trades or your Trump does really, I guess, tap the out button, we could see a lot of oil price pull back to longer term levels, which by the way, it looks like in terms of oil futures is probably around the $70 or so per barrel.